Welcome to the video series on risk management in trading. In this series, I will be covering money management and risk management in great depth. So in this particular part, I will be discussing another important concept in risk management, that is importance of knowing R multiple in your own trading strategy. After finishing this part, you will have good understanding of how R multiple can be used to maximize profits and minimize losses in stock market. So let's get started. So in the previous video on risk management, we did look into risk of ruin in detail. In case you have missed that video, link to the same would come up at top right end of your screen. In this particular part, I will be explaining why R multiple is so essential in trading. I'll be showing you how to calculate R multiple and how to interpret R multiple data for better risk management. I'll also be introducing you to the concept of R multiple total and how you can use this data to select trading strategy in the market. Towards the end of this video, I'll also be sharing some practical insights into using R multiple to exit trades and how you should mark R multiple on charts to help you get perspective of the underlying trade. I'll also strongly recommend for you to read Trade Your Way to Financial Freedom. This is a book written by Dr. Van Tharp, and this book gives you good insights into managing risk reward while trading. Now, I have put out the link for the book in the description box below and in the comment section below. So let me now show you how to calculate R multiple in trading. Now, this calculation is very easy and can be easily replicated in an Excel sheet. To calculate R multiple, you would require two data points. Number one, profit or loss per trade, and number two, risk taken per trade. In this example, if you see, entry price is 100, stop loss is 80, and exit price is 140. Initial risk is defined as entry price minus stop loss, that is 100 minus 80, which equals to 20. Profit for this particular trade is exit price minus entry price, that is 140 minus 100, which equals 40. So R multiple here would be 40, that is profit divided by 20, which was the initial risk. The final value therefore comes out to be 2. I hope this particular calculation is clear. So let us now understand how to interpret R multiple data and why it remains the key to success in risk management in trading. In this chart, entry price, stop loss, and exit price is given out in the first three columns. Now, data for risk in figures, risk in percentage terms, and total trading capital is given out in column 4, 5, and column 9. So data for profit and loss is given out in this particular column. So based on this data, R multiple for each trade is calculated as profit and loss divided by risk taken per trade. So if you look at the first trade here, R multiple is given out as 0.34. This means you risked 6,000 to make a profit of 2,055. Therefore, your returns here was 0.34 times the initial risk that you took. I hope this is clear. If you look at the second trade here, in this particular trade, you risked 3,800 to make 7,800 as return. In terms of risk, therefore, you made 2.07 times of the initial risk you took in this trade. I hope the interpretation aspect is clear. Now, one of the advantages of calculating R multiple is that you're always measuring your profit or loss with respect to the initial risk you have taken in the trade. Now, this is extremely useful as you will be more careful in your trading and you will be disciplined and will have a systematic approach when it comes to risk management. So this chart that you see is the same R multiple data that we saw in the previous slide. So I have plotted the data for you to understand how R multiple data looks like in real life trading. Now, out of these all 20 trades that I've shown, look at how many times one loses in the market. Now, you need to ensure that you don't lose too much money during these phases. This is absolutely crucial. Now, most beginners in the market lose more in loss-making trades and make less profits in profitable trades. Therefore, you need to ensure this does not happen with you. In this example, R multiple, if you see during loss-making trades, is between minus 0.49 to minus 1.17. If you look at the profitable trades data, most of the R multiple data ranges between 0.34 to 0.52. There are just 3 trades that you can see here that have R multiple above 2 And then there is this one trade that has R multiple of 8. Now this is what happens in real life trading, and this is the main reason why consistency is so important in trading. There are just few trades that change the entire landscape of your portfolio, and during such phases that I've marked, you need to ensure that your profits run and you don't sell out too early. During the other phases, you will incur losses, and this is where you need to be proactive in order to protect your existing capital. At all times, you should aim for your losses to remain under 1 hour, whereas your profit should be as high as possible in terms of the risk taken. This, in my opinion, is the golden rule of trading that very few traders understand. So let us now understand the concept of R multiple total. This is again a very important concept in risk management, and therefore do watch this closely. So in your current trading strategy, make sure you take data for at least 100 trades and then compute R multiple value like I've shown in this Excel sheet. Once you compute the R multiple values, add this data and compute your R multiple total like I've shown here. Now computing this data point is important on 2 counts. Number 1, this is required to learn how much you will earn over the next 100 trades in terms of your initial risk. And number 2, this will help you decide if you should be trading this current strategy. In this example, if you see, total R multiple for 20 trades is 12. Now due to space constraints, I could not post data for 100 trades, but for 100 trades, the total R multiple value was 67. Now as a trader, knowing this is extremely crucial, as I would know that if I stick with this strategy for 100 trades, I do stand a chance to make 67 times of my initial risk in trades. So this would help me remain calm in phases where trades are not working in my favor, and I would continue to execute trades in a disciplined manner. I hope this crucial point about R multiple total is now clear. So let me now explain how R multiple can help you choose from different trading strategies. Now as a trader, it is very common to have multiple strategies, and hence the question remains how to shortlist which strategy to trade. Now if you're beginning in the stock market, then use the combination of drawdown and R multiple. So drawdown is marked here and R multiple data is in this particular column. Now as a trader, you should choose such a trading strategy where drawdown is minimum but R multiple over 100 trades is maximum. So before heading forward, let me take few seconds to explain what drawdown is. So in this chart, I have plotted cumulative profit and loss of a trading portfolio. Now drawdown is the difference between high of the trading account and low of trading account that is expressed in percentage terms. So this actually represents how much a trading strategy can lose in market, and hence this is an important metrics to track. So if you look at this example, system A has drawdown of 10% and R multiple is at 35. If you look at system B, drawdown is at 7% and R multiple is at 33. So if I have to select between system A and B, I would actually prefer trading system B based on the combination of drawdown and R multiple. In this entire example, if you see, I would prefer system J because it has a drawdown of just 7%, whereas R multiple is at 41. I hope this advantage of R multiple is clear. So let me now show you how R multiple distribution chart can be immensely helpful when you need to exit trades. So based on the example in front of you, I would note that average R multiple for this trading strategy, that is for winning trades, is between 1.5 and 2.2. For all loss-making trades, average is between minus 0.6 and minus 0.9. Now in real-time trading, if I get a trade that gives me 3-hour return within the next few days or hours, I would be inclined to book out on some profits at least, as R multiple of trade is clearly above the average R multiple of this trading strategy. I hope this important point is clear. Now, if I get a trade that is not working in my favor, I would know when to exit it by looking at the historic R multiple for loss-making trades. Under no circumstance would I want to take more loss than historic average loss of trading strategy based on R multiple data. This is again a key rule in risk management, and therefore do take note of this. In this particular example, if I find R multiple of trade below -1, I would immediately reduce my position size or would entirely book loss on the particular trade. Let me now show you how I mark out R multiple data on the chart, and this is something I do for each and every trade, and this definitely helps me out in overall risk management. So let us assume I am taking entry at this level and I have marked the stop loss here. So the difference between entry and stop loss would be my initial risk, that is R. Once I have taken entry in the particular stock, I then mark out 1R, 2R and 3R level on the chart. So as trade progresses, I constantly take note of profit in terms of R multiple. This actually helps me get an overall perspective on trade with respect to the initial risk I have undertaken. So in this chart, if you see, even though price is rallying at this particular point, I would be inclined to book out some profits at least, as trade is already giving me 3 times of what I have risked. So if you're someone who's new to trading, I would strongly recommend for you to start marking out this on the chart, that is multiple R levels. You will immediately see a difference in your overall thought process, and this will help you exit trades better. So let me now explain how you should be proceeding forward with R multiple. So to calculate R multiple, you can either use Microsoft Excel or you can use softwares like Trading Blocks, which actually help you calculate R multiples for many trading strategies at once. In my own opinion, Microsoft Excel is more than enough to compute R multiple. It is just that it takes a little more time to get the results, as there is a lot of manual work required. In case you want R multiple Excel sheet, do let me know in the comment section below and we will email it to you. As far as R multiple is concerned, your entire focus should be to keep R multiple of loss-making trades between -1R and 0. So once you finish computing R multiple data and drawdown statistics, do let me know in the comment section below for my feedback on the same. So kindly consider hitting the like button and sharing this video if you find it useful. Thanks a lot for watching this video, guys. Take care and be safe.